Billy, great to have you here. Perhaps you want to introduce yourself to the audience?
Great, thank you for having us. My name is Billy Liby. I run a firm called Upper 90, and we look for businesses where credit might be a tool to help founders grow in addition to equity, and Rollups has been a core focus and continues to be an area of interest for us. And it's really trying to figure out the quality of the assets, the predictability of the revenues, and it seems to be a very in vogue topic right now with the pullback from tech.
It is. I must say that Upper 90 was a source of inspiration for us. A big part of our audience are starting their own roll-up companies, and that could be tech, non-tech. Mostly in our end is generally SaaS or online businesses, but we do get some requests from people that are rolling up companies in different sectors. So it would be great to understand what makes a roll-up strategy qualify for financing from Upper 90.
So what we've learned is you want to make sure that the assets can be bought at a reasonable price. I think just like real estate, so much of it about is the buy. You know, if you can buy things at a good price, there's room for error. Number two is, can the team demonstrate that these assets can be run better or improved under their watch versus the existing owner's watch? And that's easier said than done. You know, you have people that are often spending 24 hours a day, 7 days a week, responding to customers, continuing to iterate. And, you know, often you have somebody on the financial side saying, hey, well, if I can buy a grouping of these, you know, they're going to be more valuable. So I think one is the buy, two is how do you demonstrate the ability to improve these assets post-acquisition, and number three, and we're seeing this increasingly, is there a corporate structure that allows you to maintain the talent versus buying them out completely? And so that's something that we're seeing is more of a structural opportunity versus just kind of, you know, buying assets and forgetting the previous owners.
Makes sense. You know that we generally work with very early stage acquisition entrepreneurs. So we help them acquire the first few acquisitions, and sometimes we had referrals from you guys. Is there, I mean, you mentioned quite a number of things that you're looking into these projects. Are you looking to have them demonstrate that with a track record of acquisitions, or is there any other way in which they can demonstrate that even if they haven't acquired businesses already?
It's a good question. So one is leverage works both ways. And so I think what we're seeing now is a more balanced amount of equity and debt at the beginning, or even maybe more equity than debt, which is a change. You know, I think you could finance a lot of these with debt and less equity. So I think that you just need to have some balance between those two sources of capital today. That's one. Number two is these seem to be, you know, the effort and time to manage a small asset can often be very similar to the effort and time to manage a medium to larger size asset. So we're also seeing people raise just total larger amounts of capital to have the team and the expertise. And often there's more stability in some of the larger assets that have more of a moat or a brand. So I think it's just more capital and then more balance of debt to equity in this environment. That's one. You know, in terms of what we're seeing, it really ranges. We've seen, just if I look at the last few quarters, companies that are rolling up offline businesses like pest control. We've seen other businesses that are looking at software roll-ups around Salesforce's ecosystem, around Microsoft's ecosystem, you know, similar to what you saw with AppFire, which is interesting to us because there's just less moving parts in that business versus maybe the complexity that you saw in the Amazon ecosystem between supply chain and procurement and inventory. So that's another area that's interesting as you see some of these new ecosystems develop around some of these software platforms. So those are the main things that just kind of immediately come to my mind.
Yeah, you touched, by the way, on something interesting. Rollups based on an ecosystem. We saw Shopify rollups in the past. You mentioned Salesforce rollups. We've also seen some people that are buying Atlassian plugins. What do you think about that? And I agree with you that it's obviously less risky than rolling up together e-commerce brands that have a lot of complexity, but you still have some sort of platform risk. How do you assess that platform risk?
Yeah, it's a great question. One of our friends is a senior executive at AppFire. And, these markets are very big. I think my partner, Jason Finger, who is an entrepreneur himself, he always says there's always another deal. I think that there's always something else to buy. These are huge ecosystems. So I think a lot of people rush in and try to buy as many assets as they can and, try to have this first mover advantage. And there is an element of that. But, I think a lot of it is like, do you have the technology skill set to actually know how to improve these assets? So I think often we try to shy away from a leadership team that's like finance first and, operations second. And I think if you can demonstrate an ability to grow these assets and to improve margin, there's going to be an ability to, people are going to want to sell their assets to you. So I don't know enough about, the Atlassian ecosystem, but my understanding is that's growing 50 to 100% a year. And if you have demonstrated an ability to, kind of grow your assets that you've bought similarly, there's probably a lot more room to run in that ecosystem versus having to now go and learn a new ecosystem like Microsoft. Yes, to go public or to, raise massive amounts of money, there probably has to be some diversification, but I think people often think about like phase 2 and phase 3 and then don't execute on phase 1.
Yeah, I agree. And then in the end, having an experienced operator is super important. I totally agree with you. And that obviously the risks a specific rollup. And we get a lot of people from finance trying to buy businesses, and this is not as easy as it seems. Yeah, I agree with that. By the way, you also mentioned equity. You guys offer equity, right? Other than debt. What other sources of equity are people using for this type of roll-up strategies? Is it more like private equity type, venture capital? Where does that come from?
It differs. I always say, the most expensive capital will exist at the earlier stages of your business. So we were looking at one team that was looking to roll up assets around the NetSuite ecosystem, and they ended up taking private equity. And and then look for cheap debt. And, I guess that is a way, if you can go and get private equity to come in and write a big check, it does de-risk the business, because you just end up having a lot of cash on the balance sheet. But, these are fast moving ecosystems, and it just seems like there's a time for private equity. It just seems like when you're just starting a business that doesn't seem optimal. So I think a lot of it is, VC is looking at roll-ups as an asset class. We looked at a deal with Forerunner in a company called Stress Free, which is rolling up auto body shops and bringing technology. We've looked at another company with a family office, which is a source of capital that's been rolling up and building out as well organically, mobile dog grooming businesses. So I think there's I think it's finding a niche industry with a credible team and thinking about, some 1-to-1 ratio or something around that between debt and equity, getting your first asset or two in place, and ideally having a structure that allows you to buy, maybe a majority of the business while still retaining some of the key talent. Like I think Team Shares has done an interesting job centralizing some of the back office functions for small business operators, allowing them to focus on what they do best, but in-housing, back office, finance, tax, hiring, etc. So I think there's also just some interesting platforms and structures, not just kind of rolling up and, hey, I can do it better than the person who owned it before.
Yeah, makes sense. It's interesting because I always thought that this type of business or asset class was not very well fit for VCs, because I'm thinking of VCs just following a playbook that says we gotta make like 100x and find something that's super scalable, very small team. And this looks like a little bit less scalable, but at the same time, there's perhaps a lot of good returns to be made.
It's interesting, I have a couple kind of jokes. Like somebody I read, you're more likely to play in the NBA than you are to run a billion-dollar startup. So the odds of the 100x, it sounds great, but they're still very, very low. I think a lot of people, which has always been our premise in Upper 90, like there's a lot of very good businesses that if you don't take too much dilution and you own enough of your company, thinking about how can you use debt earlier along with equity, then if you have an exit for $50 or $100 million, but you still own 40, 50, 60% of your business, that would be the equivalent of most management teams when a company becomes a unicorn, I believe, owns less than 10% of their company. So I think that as long as you set up the balance sheets of these companies properly and can ultimately use cash flows for growth, or maybe once you prove the model can raise some debt, like it does potentially hit VC returns. And so we actually talked to a VC in New York who I respect a lot that came out of Insight, and they're looking at fast casual and looking at some of the new burger companies that have very fast payback periods. There's a joke right now, the Stanford MBA graduate doesn't want to go work in high tech. They want to go run an HVAC business in Idaho. So there's probably like a bit of a bubble here where everyone's like, hey, I don't want to, go and the growth and PE markets on hold. I don't want to go into the fast growth tech, outside of AI. I want to go and run a profitable business. But to your point, like that's easier said than done too. It's like, so nothing's easy, but I think as long as you set up the balance sheets where Upper 90 can kind of be that thought partner and that capital markets partner, we're an investor in a company called Coastline that's become the largest driver's education school in the United States.
Yeah.
We're looking at a company now that runs one of the larger truck driving education for long haul trucks in the US. So I think there's a lot of interesting niches, but they're kind of in between private equity and VC. And to your point, they don't fit in a perfect box. And we've always kind of prided ourselves on being a little bit of how do we help, good founding teams solve complicated problems. And this is kind of one. It doesn't fit in a perfect box. And if you don't set it up with the right capital, and that's probably maybe some of the issues with some of the other, players that we described, like maybe this isn't meant to be 100x business, to your point.
Agree. I think there's a way to make these businesses scale faster. You can apply technology to all these offline businesses, and there's a big opportunity to be made by improving the systems, and that increases the scalability of the business. Obviously, a service business is a service business, and you need people for running it. But there's a big opportunity in improving methodologies and technology that.
So that I agree with you, and that's what there was a company called Splash that was, I believe, backed by Slow Ventures, who we respect as well, and they're rolling up pool services businesses in the United States. Now, on its own, like that kind of has a cap. There's only so much more you can do, but all of those little improvements. So there's a shortage of labor for pool services. So how do you train more people? How do you schedule more efficiently using technology to fill up people's time and reduce kind of, gaps in the day? And then how do you maybe upsell other services? So I think the home services space, that's what we like. This person knows the space. They know that the asset's not yet in private equity's focus. It's small enough. They can come in. They have ways to uplift it through technology. and they've raised kind of a good mix of equity and debt, as well as maybe seller financing to keep, some of the people selling aligned. So I think those are the things we like. They're just not going to be the most scalable outcomes in the world, but we don't run, like, I've always felt funds that get too big are looking for, to make something what they're not. So as long as you keep your funds small, which we both have tried to do, or, big enough, then you can look at some of these niche opportunities and get in early.
Yeah, makes sense. All right. Let me change topic. I think
Sure.
I got a couple of questions that I would love to ask you because I think they're relevant again for early stage roll-up companies. We bump a lot into one issue, which is seller financing that is not correctly structured, like either very short-term payments or not properly placed in the capital stack, so it clashes with our own financing. What do you think about that? What do you typically request in terms of seller financing, and how do you see that as part of the capital stack?
It's a good question. I'm not an expert on this. I think you might even have, you likely do have a better perspective. I think part of it too is sometimes people try to do everything one way. So like, hey, I want to buy an asset, I want to finance it all with seller financing, and and then you can't really maybe service the payments, or if you have any issues, you kind of are. I'm a big believer, like, you should always overcapitalize your business. So just taking a step back, it probably is like there's a role for equity, there's a role for seller financing, and there's a role for debt. Now, where all those sit and fit together, I'm not sure, but my guess is that probably people are, trying to do too much with one piece of the capital structure, and then it like puts too much pressure on the business.
Yeah, that makes sense. On the other hand, I think the market conditions are relatively good now to secure up to 50% seller financing. We've seen that sometimes between 20 and 50% seller financing.
Yeah.
And I totally understand it from the perspective of the buyer. If you can do that, that's cheaper, obviously, than one of your lines, one of our lines. And they want to have that too in the capital stack, right? But sometimes it just generates a lot of confusion on how things should be done. Also, earnouts are typically generally a way of aligning incentives between buyer and seller, but sometimes it ends up being just like noise around the transaction. So I don't know. I thought that perhaps you have seen that.
Like in that company that was on the pool services, like if you can get really good, attractive seller financing, like I think founders should do that, right? But I also think they should have a plan. Like there's only so much you can do of that. So, it's okay, I'm going to do it for these first initial acquisitions. And then I'm going to think about how to raise a debt line. And I think getting somebody like yourself or Upper 90, it's most founders, like these are complicated structures, and getting a partner, if you know that credit or structured equity are going to be part of your plan as a business owner, I would just encourage founders listening, think of how to try to get a group into the company earlier to help you think about how to solve and set up these things for growth. Versus like, I'm going to do this and I'll figure, like, I just think that roll-ups inherently, it's a capital intensive business. And so I think you just want to, when you think about your cap table, I often find a lot of companies, they get like 4 VCs on the cap table. They offer the same capital, the same advice. Like, pick a good VC, pick a good group like Upper 90 or Boopos, and do seller financing. And I think that having more capital tools will help you grow and solve problems.
Yeah, I agree. And again, I have another very specific question that we get asked all the time. What do you think about, you mentioned before that obviously having a strong team that can run the business and scale is very important, but at the same time, having a too big team at the beginning costs money, right? And you have to kind of set some money apart for paying that structure, or figure out ways so that it's not too big for like being a hindrance to the business, but at the same time, it's strong enough so that you can scale and buy more businesses. What's the thinking behind that, and what's your sweet spot in terms of the right amount of overheads that early stage roll-up companies should incur?
It's a great question, and it kind of touches on some of the stuff that you're highlighting. There's some people that we've come across that said, hey, I want to go be my own boss. I want to buy an asset, and I want to more of a lifestyle business potentially. I'll get SBA financing, or I'll do seller financing, and like that makes sense. And you can probably do it very lean and have a successful personal business. Then on the other side, it's like raising, to get VCs to look at this and to get growth equity and to get a lender like Upper 90. Now, we want a path to put at least $10 million to work over the next year. We don't want to like $1 to $2 million. We can start, but it just ends up being a lot of work, and that's where a partnership with you makes sense. But I think that you either like in life and businesses, it's like the barbell. You either want to be like really nimble and lean and like almost like a solo team, or you want to have a business that has enough scale and can raise money. And I think a lot of people kind of get in the middle a little bit. They have not enough people, they haven't raised enough money. So I would just take a step back and like pick which one you want to be, and then raise, even if it's a little more than you want to, raise enough money just to have the more staff and more ability to show organic improvement. So I think you have to kind of be in either camp. It's hey, I don't want to raise that much money, but I need the team to do it, and you kind of get into this middle ground where I think it's really hard, to pay the people, or you're too small to raise VC dollars or family office dollars. So I don't know that would, I don't know if it's a good answer, but that's what I would say.
I think that perhaps what happens is that many people try to follow the grow big and have a big team path, but then they end up being unable to get there, right? So that's why they're in the middle.
Well, I think some people, and we're even seeing it now in some of these new platforms, like, hey, OpenAI is going to build an apps ecosystem, and so everyone's like, there are a lot more businesses. We just fundamentally believe it's, the heart of the US and global economy is driven by small and medium-sized businesses. All of these new technology platforms allow people to start an app, to build a Shopify store, to build a plugin on it. All of these are positive, right? It lets people be their own boss. What I think people are jumping in and saying, hey, if we're not the first and the biggest on Salesforce, like someone else will be. And so everyone kind of just tries to go, and I think we saw this with the Amazon space. Like there's tons of assets to buy. I mean, there's tons of new small businesses entering. So I would just encourage, like, be big enough to make sure you have a team to operate, make sure you can buy assets that are big enough that have some durability. But I just think the people that feel the need to kind of go big and go fast, I think this is a long-term trend. And so just be a little bit more patient, and there's always going to be another asset to buy. So that's, I think, a big focus for us. But at the same time, you don't want to, we don't want to fund a small random product. So it's a balance of,
I tend to think that this company should be set for at least 10 years. And many people are thinking that this is something that you can just implement and then in 3 years just exit and make a ton of cash. But you have to be prepared for lasting longer than that.
I agree. And that there needs to be actually some true synergies between the assets. Right? If you own a couple on this platform and a couple on that platform, yes, over time you need to be omni-channel, but that's why I think the software assets are probably more manageable, just because, it seems like there might be more synergies if you buy one Amazon store and their supply chains in India and another one's in the US and another one's in Mexico. It just, I think it's another thing is just you want a business that can sustain a reasonable margin profile. So can a business have a 15 to 20% margin profile? After all the corporate expenses and not asset level EBITDA. So I think that's another thing we've been increasingly looking for. It's just businesses that, have the ability to maintain a healthy margin. Because otherwise you need to keep raising money, which is hard.
Yeah, and that's why we saw some of the early e-commerce rollups fail, because in the end they had a margin that wasn't able to pay for the overheads. So that's super important.
Yeah, and the capital markets change, and the multiples to buy these things also change because so much more money came in. So I just think discipline, being like not overpaying for assets and making sure you can maintain a reasonable margin profile. So.
All right. Well, we're getting to the end of today's episode. I'll let you, perhaps you have one last message for all these early stage roll-up entrepreneurs, people who are like buying the first couple of assets, and they have like a thinking that at some point in time will want to use your financing. What would be your top idea or the top recommendation?
It's a great point. I mean, there's been something in my mind that's been maybe easier to understand. It's like offline businesses with the ability to bring technology to them. Mm-hmm. Like the pool services roll up, the home services roll up in the pest space. There's like, it just seems to me there's a little bit of a moat. Like you need people to run and service. It's not just all AI and online. It's like, think of the technology as a way to help improve versus, trying to have the latest and greatest app on, an ecosystem online. So that would be, where can technology help improve versus it having to kind of like stay on the latest curve of technology. I always think like these niches and these small bespoke areas that I mentioned on this meeting, like who would have thought driver's education or funeral homes, or like it doesn't, these industries, all of them, even if they're niche-y, are probably bigger than people think. So it doesn't have to, hey, unless we're around the meta ecosystem, it's like if you can execute and you can get a good operational team and you can kind of start with a reasonable balance sheet of debt and equity, like don't over constrain it, there's probably lots of ways to win, versus like I have to be in the highest growth ecosystem.
Totally. Well, all right. That's all on my end. It was a great pleasure to have you here today.
Yeah, we appreciate the partnership. And, I think if somebody's, for us, either if you're looking for that first credit facility, that is probably around that $10+ million range, think of us. We've also just seen a lot of companies that are later stage that we never would have thought of before, but the capital markets are broken. So if you have a complicated problem, like, hey, my existing lender needs to be refinanced, or there's a bigger asset and it fits outside of our credit box. Like, I think those are obviously usually very like interesting situations, but like that's another area that in this the kind of broken capital system right now for late stage companies, there's also that for you and I that we usually focus early. I think it's also an opportunity to be like a problem solver for later stage companies now too.
I agree. Yeah, the financing environment is generally tough. So
yes, especially equity right now. So yeah, so thank you so much for having us, and hopefully we can hear from some of your audience and do more stuff ourselves.
I hope so. All right, great. Thank you.
Thank you.
Have a great day.